Hey everybody, welcome back to Markets and Sectors. My name is Mike Fairborn. It's great to be back with you folks. Really interested in taking a look at what we're seeing in the markets today. In fact, we're seeing some areas within the market of potential pullbacks. I want to talk about the potential pullback to maybe the next level of support, perhaps. We're talking about a number of different potential indications that we might be seeing out in the markets that could be responsible for that. Of course, we do want to look at our sectors as well. So we'll take a deep dive into sector analysis and see what is moving, where our strength and weakness is at. I'd like to welcome you all here with us today. We've got Jay Richardson, Beth, Kevin, and Riceberg. I'm joined in the chat by Brett Crowther. Folks, any questions, comments you have, throw those in the chat. I'll try to keep an eye on those as well. As a quick note, too, you can join us on X. My handle is Mike Fairborn CS. You want to make sure the CS is at the end. Brett Crowther CS. So with that, let's go ahead and dive in. Got plenty to discuss. So I would like to jump into disclosures right away. Information here is provided for general information purposes only. Now, Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application is for education purposes only. Investing does involve risk, including for some products more than your initial investment. As we talk about that right there, there is a list of futures disclosures as well. So please be mindful of those. Futures and futures options trading does involve substantial risk. It's not suitable for all investors. Some additional notes to keep an eye on as well. Finally here, past performance is no guarantee of future results. All right, so with that, let's get sharing. Let's get going here. Ooh, we will take a look at the TYX and TNX just momentarily. Let's start off first, though, with our broad markets. In fact, I'll go full screen here. And by the way, welcome to all of you just joining us right now. We've got Never Eat here. We've got Price, Life in the Fast Lane, Tom, as well as Riceberg. Great to have you all. All right, well, here is the pullback, right? As we're seeing it with about an hour left in the trading day, getting a little bit of a follow through to the downside. Folks, it's been a really, really big run. One thing that we hadn't discussed, I know we had brought into detail the last several weeks, breaking above the 61.8% Fibonacci, which a lot of traders, investors will look at as a gauge, as an indication. If we're greater than that, then a lot of times it may suggest to them that the trend may continue on up. If we keep that same theme in mind, well, then some traders might think that perhaps we might come back down to a prior level of support. In other words, we still might continue this upward trend. That is the question. We don't know if that will happen, but we did get above the 61.8 that could suggest some support. And this was a long-term support, I should say resistance level as well. So resistance we got above, and we really gapped above that right here as well. But if we look back at maybe some key support levels, what we might find real close to that 5,800 level, notice we had touched off that level. We'd actually gapped over there previously as well. Touched here or very close to it. This is the top of the gap right there, right at the 5,800. So this may in fact be the next level that traders might be keeping eyes on as they look at this. Here is a look at the actual 50-day moving average. I did get this interesting chart from Ben today, except we were doing a tag team event this morning on Trader Talks, which was really fun with Ben, but he'd highlighted this, and I'd be happy to share this with you as well. It is a script. I'll share it in the chat here, but it is interesting. It does highlight where the S&P 500 is at. Now, a quick note, this is highlighting the S&P 500 hundreds gains over the last 1 year in terms of a percent. All these additional numbers are on the left side of the y-axis over here. And you can see like right here, there is your read right there for percent above the 50-day moving average. And basically what that is we're just looking at the number of companies now above the 50-day moving average. That stands for simple moving average. Some of the three big ones, I'd say that the 100 and as well as the 200 might be the biggest one to look at, but the percent above, and you can see those, although they're not listed as a percent over here, it does show what some of those numbers represent, and it shows that, hey, we don't have too many that are above the 200-day moving average. Although the S&P 500 is above its 200-day, we don't have nearly as much, and you can see just by this graph here We have more above the 50, which kind of stands to reason. We've had a good strong rally, but less above the 100, less above the 200. If we can start to see more of these companies get above the 200-day moving average, then you would tend to get a little bit more breadth or more indications of breadth in the market. All right. We had a longer term upward trend too, above that 13-period monthly moving average that we've been discussing week to week as we go into it. In fact, I'm going to make sure it gets saved this go around. We've had a couple of weeks and we've been saving a bunch of these. I'll save it to the grid now so we do have it, but I'll just go 13. Let's extend this out. This again tends to capture a lot of bull and bear market moves. In fact, let me just resave that so it's updated now. Longer term, you can see this captured basically prices were above the 13-month moving average. It's a monthly moving average since we're on a monthly chart. We were above there all year. Last year, 2024, you can see once you break above, sometimes you can hold above those levels. And again, we did break back up above here on this massive sort of a hammer bounce. And here we are kind of testing this range right here. So that's going to be an interesting one to watch. Can we hold the 13-month moving average? Looking at this on a 15-year S&P 500 chart. Before I forget, sorry, I want to make sure I share this with you. And a quick note too, is I share this ThinkScript into the chat just so you guys have this. Is it going to pop up here for me? Oh, there it is. Yeah, perfect. So I just threw that in there. That is for this chart here. ThinkScripts are not guaranteed for timeliness or accuracy. I say that every Friday because I do teach that ThinkScript class on Friday. But as long as the data is correct, and we have pretty good data on the platform, that's not really a question. I mean, just to clarify that. But as long as that data is correct, then these ThinkScripts should be providing the right information. But wanted to just give that little note and disclosure there. It's not guaranteed for timeliness or accuracy. All right. So with that, let's continue on. I wanted to look at other markets as well. Before I do that, a couple more things on the S&P 500. We want to switch on over and use the ES in this particular case. And the reason is because we get that volume. We get volume on the ES. And sometimes, as you can see, the volume doesn't look as big. It's not nearly as high. You know, the spikes are really quite low relative to these major reversal points. And that's okay. Doesn't mean that we're running out of volume. In fact, if I draw my line all the way through there, you can see that we were clearly above. I should say this level that we were at generally over here meets the same range we were at over here, here, and here. This kind of volume is not a negative for upward moves in the market using the ES. That is the futures contract. The E-mini S&P 500 index futures contract is as a guide. And specifically, money flow down here, which tries to net out net buyers relative to net sellers. And what you can see over here is that this collectively looks like, according to the money flow, substantial buying pressure. In fact, if we draw a line right through there off that high, if I can draw a straight line, you can see that we're virtually on par with these major highs over here. And that tells us, again, that we might be in a position, remember getting above that 61.8% level, which was roughly right there on the Fibonacci. I guess I could have just drawn the line in there. I'll do that real quick. Make sure we've got that lined up correctly, but off the tops and the bottoms. This is on the ES, so it's a little bit different. Oh, look at that. I've looked at it so many times, we're basically right in the middle of the 61.8. So there you go. We got above there, but what this suggests is that maybe those traders that do believe that if we find strength above the 61.8 Fibonacci level on a retracement, that we will get strength going forward. The money flow, MF for short down here, is showing us a positive indication right now, so much so that it says that, according to money flow, we could break above this level. Since we are virtually exceeding that level right now, yet at lower prices, right? As we discussed last week right there. That was right at 6,000. But notice we were up here, money flow already at this point, despite being at lower prices. So there might be enough fuel left in the tank to get us above there. And that would help to solidify that 61.8 break above on the Fibonacci scale as well. So I wanted to highlight that again. We can do that just by going to the /ES. Now, back to some of the indice charts, and here is that NASDAQ chart. NASDAQ really, really quite strong. We weren't for sure if we would get like I've got an extension in here, if we were to get possibly an inverted head and shoulders pattern. Well, let me swap up the colors here so we're highlighting that. But if this was in fact a shoulder, head, shoulder, which we didn't get as a higher shoulder, right? You know, the right side of the shoulders sitting up a little bit, but that in fact is the neckline right there. That's the neckline, NL for short, right here, the neckline. And we broke above that. A lot of times the retracement is the length of this price move to the upside. And what that could foretell is a bigger move in technology stocks. This is pretty tech heavy, the NASDAQ 100. In fact, if you can go over here, you can confirm that anytime you want to, just NASDAQ Market Watch here. We'll go to quotes, since I've got the sub-industries in here. And, just clicking in here, you'll see that, look at this. I mean, semiconductors, software, application software, biotech, still considered technology. Healthcare equipment oftentimes is as well. So it's not 100%, but it could be an indication of strength within that group, as you can see. And that's a big, big move. And we've seen actually, just to dive into this a little bit more, but like companies like Meta have had a pretty strong rebound. I believe Amazon, kind of like a flag as well here, but selling a little bit off. We've had Alphabet coming off the bottom. We'll see. It's a little bit like not exactly a rounded bottom, is it? Or not exactly a cup and handle, but it could be cup and handle-ish or rounded bottom-ish if you start to break out of some highs. But some of these have really been big leaders, and this is, possibly in the line of communication services, Netflix, really, really quite strong. But back to the NASDAQ, breaking above highs, extending higher, perhaps we'll see a support level come in here as well. To do that, whether it be the NASDAQ or the S&P, I'm back to my fibs. I'm going to click right here. I'm going to draw this up to the top and say, well, where is the next potential support level according to the Fibonacci's, and where might it anchor? Well, there's the prior high in this move, and it looks like it comes right at that 23.6. So that could potentially be the first support level. It doesn't mean though that we're going to fall this far, right? We could hold up, we could flag right here, which is what we have been doing. Flag. This was a little bit deeper, but it could be a really like a bull flat as opposed to a bull flag, and really kind of stay tight. But that could be support. If I could finish writing that word out. There we go. Support right there. So these could be interesting areas because they might be bolstered. But look over here with me. If you come back over here too, if we were thinking that technology could be something that could really be strong going forward, that was a major gap right here. And you could see a support. This was resistance. So some historical indications too that support could come earlier than that first leg of that Fibonacci as well. All right, well, welcome, George, a probability trader. Great to have you on board as well. Will, joining us here. Looks like Brett has got our chats all caught up. Perfect. I was just taking a quick peek and seeing if there's anything that I could potentially visually show, but I think we might be doing all right. Good. All right. Well, let's do this. Here is a look at the Russell. The Russell had an interesting flag sort of pattern here, right at resistance previously, but we began to break down. Remember, these small cap stocks can be ultra sensitive to higher interest rates, and the Fed did pass on interest rates last go around. We'll see what happens if they do it this go around as well. We don't know for sure. I mean, there's June, and I think September would be the next one. But a lowering of interest rates can certainly help those small cap stocks, which, by the way, lower low, lower low, lower low. It's got one more lower low than both the S&P and the NASDAQ out there as well. So just park that in the back of your mind. Folks, one other thing, too, a couple more things I wanted to mention that we might be seeing here in terms of why we could see a pullback here. Today I think we just made a yearly high on the TNX, the 30 year. I think you have to go CGI on this. TNX CGI. That is the symbol that we have to plug in now. And I put that into the chat just so you can see it. No, it's the TYX. That's the 10 year. The 10 year is breaking higher though. If you move that decimal over, it's about 4.59. So very close to 4.6% today. The TYX, on the other hand, is at a yearly high. We did break above 5%. So the 30-year bond is above 5%, and the higher that goes, the more it becomes a competitive force for traders, investors out there to take money out of the market and put it into a treasury, for example, that has a rate of 5%. It's the highest we've seen. I've just got a 1-year chart up here. So that could be actually a driving force also within the market too. So keep an eye on that. The other thing too, you have to add to this is with this is a pretty big upward move, right? That was a solid winning streak. And a lot of this was based on tariff information, tariff news coming out, the postponement of those tariffs as they work through that process, a 90-day pause. I know initially we got a lot of that going, and there was another 90-day pause right there for China specifically. So I think you had like, that was the initial spike was there, but it's been a big run. And so perhaps we could come down, particularly with those interest rates going higher, making things a little bit more competitive. Now, with this too, I'm going to take advantage of our futures here and take a look and show you what we had been seeing strengthen when the markets weren't recovering. And that was gold. Gold has been strong for quite some time. In fact, if I go to a weekly chart, boy, there you go. Really, 2023 was incredibly strong through 24. Okay, so this is 24. Yeah, so this is 24, 23 is the recovery. And you can see gold right here. This is the bounce on gold that we're getting. And gold really didn't come back that far, despite the markets spiking up. Like the S&P was like this, right? Just massive moves to the upside. Gold just kind of dipped a little bit, kind of went right back and consolidated near a prior high around 3,200. And so here is the possibility of a bounce here. So if we're looking at strength out in there in the markets, I'm going to look at sectors here in just a moment, but this is a commodity. And so I wanted to show you specifically the commodities here. That is a commodity, and we may see some follow through. Some of the bigger names, in fact, some of the strongest performers within gold have been Agnico Eagle. This too, like gold, looks very similar. That's a very strong run through last year. This was, I think, one of the key leaders in the group. We actually put on a swing trade on this yesterday, and that is our paper money target right there, if it does turn into a flag and goes to the upside. But so some others in here as well have been rebounding. Here is Newmont as well. So we'll see what happens with these miners, but that could be of interest. All right, let's do this. For those of you that might be looking for an offset, if the S&P 500 does come back a little bit, maybe this shows strength. And another reason too why commodities could show some strength. Let's look at the dollar right now. I wanted to highlight the dollar. The dollar has been it broke through a major low down here. When I say major, here's our weekly chart. So through 23 and 24, we had some major lows here in the dollar, which we did actually take out. We don't know if we're going to hold at this level. It was a very, very weak recovery. It almost looks, in a lot of ways, like we saw over here. Very much bear flaggish with lower lows and lower highs. And if that continues lower, well, that could be an issue, right? So most global commodities are priced in US dollars. So when the dollar weakens like this, it's like a sale out there, is one way to look at it for foreign buyers. And when that's the case, demand can increase for the product, and that can push commodities higher. Gold is one of those commodities. Of course, we have a whole list of other commodities that could be influenced, silver being another one. Let me just take a quick look at silver as well. So then we'll move on to our sectors here. But there is silver. I'll clear that off and go to a daily chart here. So silver maybe coming out of a flag here. Do you see it? Oh, that just got a lot thicker. Maybe coming out of a flag right there. And could it trail up now? Silver's been a lagger relative to gold. And if I back this, let me do this and zoom in. So that's your silver weekly chart. Notice we didn't even hit a new high. So we're not resting at new highs like gold was resting at new highs. We're down here, but that does look a little bit like a possible flag pattern. And there are a number of gold and silver miners out there because it's a commodity. Let me just show you how you can tap into that very, very quickly. Into the scan tab up top. Let's clear this out for a second because we can find specifically silver itself, companies in the S&P 500, silver types, well, silver miners. And we would do that. So I'm in the scan up top. Now I'm in the stock hacker. We wanted to see if there were flag patterns happening within silver miners as well. I'm going to scan in the 500 first. I don't know how many are in there, but what we'll want to do next is go to intersect, go down to industry. We're going to find it under materials, and it's going to be, these are our industries. Now we're going to go to sub-industries. Here is silver here. How many do we have? None. So we have no silver miners in the S&P 500 exclusively. The challenge here is that they might be mining more than just silver. So if I go into metals, what I could do is I could say, instead of gold or silver, because a lot of these gold mining companies also mine silver as well, we could select gold, and I think we're going to get a few, one. Newmont's the only one. So they do silver, though, as well. So what I'm going to do is I'm going to take off the S&P, and because I want to give us a list here, let's just go ahead and say all stocks, but we are going to shoot for just mainly silver. So if I come over here, we'll go into mining, we're going to click on silver. Now, because it says all symbols, I mean, we could be looking at, a massive group of penny stocks as well. So the key thing now is to use these additional tools off to the right. That is an add filter over here. Just a couple stock filters is what I wanted to add. Let's do a few of these. So just a couple. So we'll say it closes. It's got to be above. Oftentimes I use 7. You can use 5 or 10. I'm just saying a little bit above 5 at least. I wanted to say also, I want to make sure the volume is going to be there. And there's a great little volume study right under study. You can click on that and drop down here under volume. So I've just clicked on the drop down to volume here, average volume. And I'm going to say at least 100,000. Well, let's just do 200,000. 200,000. So in other words, we've got an average of 200,000 shares a day over the past 50 days. Okay. All symbols silver. There we go. We've actually only got 2 that fit into that area. That's funny. I'm sure we have a lot of penny stocks in there, like junior miners, but these might be companies that are actually profitable. You'd have to look into that. Yeah, they do have PE ratios. So we know they have earnings. So they've got a PE in there. MAG and pass. I'm just seeing if they look like, a little bit stronger, right? You got the gap up there. A little bit stronger than silver itself. And there you go. There's the other one. Just a couple. Anyways, silver might be flagging. All right. Well, let's move on and take a look at some of our sectors. So I've got a grid pulled up right now on this. And let's do this. Let's take a look at where we've been seeing recent strength. I know last week we saw consumer staples kind of selling off, but look at that. It did recover back up. That's interesting over the last few days. As the market might have had a little bit of weakness, we're seeing the defensive companies rebound right there. So defensive, maybe consumer staples. You've got healthcare, oftentimes known as a defensive sector. Let's scoot down here. Here is infotech. And so technology, though, just put these little minor flags, potential flag right now. Communication services will often trend with technology. And you can see that this is kind of a flaggish type pattern, really sideways there as well. So that's interesting too. So we're seeing some strength in here over, let's say, the past couple of weeks. Where is the majority of that strength coming in at? And by the way, the last one here is industrials. In fact, I'm going to maximize the sell on industrials, folks. Any thoughts as to why industrials would be so strong? It's tied into what everybody's been talking about in the news flow, and that is tariffs. If you think about all the money coming into the U.S., right, through tariffs. In fact, the Trump administration, I believe, last count, there were several or a few $1 trillion that have recently even been noted as coming into the U.S. in terms of for infrastructure, whatever the case might be. Think about it in terms of manufacturing, though. So reopening some of the manufacturing. There's the industrials, a really, really strong move. It could be influenced clearly by tariffs. Now, when we say that, it's going to be, that goes both ways too, right? But as long as, those tariffs keep coming in, they could be getting better deals on those tariffs for the U.S., that is, and that could definitely benefit some of the industrials. So, having said that, there may in fact be a long-term macro type driver in here too, in the form of tariffs. But again, tariffs could go either way. One of the things that a lot of analysts are saying, or even economists, is that they can start signing a few of those tariffs, which they have done already, but it's going to prompt, they expect, a lot of companies to try to jump on quickly and get going as well. So with tariffs, and that could certainly be interesting. That's a 6-month view. I want to just show you what like a 5-year weekly looks like on this as well. But it has been showing, there's the dip probably on tariffs, but there could be some additional strength. And so some individuals might want to look at something like, let's say, for example, steel. Steel could be an interesting area. There's been a lot of talk on how auto industries in the U.S. are going to do better, but one of the key, components there would be steel, and that could have a good macro driver over extended period of time as well. So keep that in mind. A quick note too, if we wanted to look at, the strength over the past 2 weeks, we could easily go to our Market Watch tab and we could pull up here. We have some of these pre-built now, the percent over the past 5-day, 1 month, 6 months in here. One thing we could also do is we could right click, we could go to customize. I've actually got this 10-day in here. There was a question that was brought up on that, so I'll just quickly show you this. Here is that 10-day. It's colored. We are going to use, though, the sectors specifically. So I'm going to click on my drop down. We're going to go down to public sector. There we go. So here are the S&P 500 sectors right here. What's been the performance over the past 10 days? What's been the best performer? What's been the weakest? To kind of show the strength of the recent trend. Because a lot of times if you got strength over that last move, this last rally, they might hold up the best. They might. Oftentimes they do because they've begun to make higher highs and higher lows. They're the strongest within the group. There you go. Discretionaries. Communication services and technology, and then industrials right there. So really the ones that we saw the charts looking good, but there is the actual data. Now, there was a quick note on this. I'm going to go ahead and just share this. Again, this is a ThinkScript, and with those ThinkScripts, they're not guaranteed for timeliness or accuracy. However, I'm going to go ahead and plug this into the chat and then show everybody. Oh, that's weird. Hold up 1 second. Try that again. Let's try that again. Clicked on share. I've got to give it, okay, should go now. Give it a little bit of time. That is it right there. Now, once you get that script, once you do just copy that, go to setup up top, open shared items, plug that in, preview, you can rename it. I've just renamed this 10-day percent. And then you can find that in a Market Watch column over here. So this is one that we did build within our ThinkScript studies on class on Friday. If you like this kind of stuff, there's a whole range of different classes in there that discuss different custom columns and and different ways to scan for different securities as well. So, all right. Let's continue on over here. So back to our charts. That's one way to kind of view that strength. as well on a percentage basis. So again, not guaranteed for timeliness or accuracy, but industrials really interesting. Breaking or very near breaking highs here. Think about the CapEx spending. I think they call it re-onshoring in terms of manufacturing back to our shores now. And we'll see how industrials do. But that could be a very interesting area, just like we were looking at previously, to scan for maybe stocks that in the industrials group. We could take this off, this off. I'm going to go into the S&P 500 now, right there. And what we'll do is we'll look at just the industrial sector completely, just the whole sector, which is going to be right up top. Select all industrials, and there you go. So right at your fingertips, actually pretty quick, you can get that to come up, although we're still waiting. Normally I click on it, it pops right up. That is how you do it, though. By the way, I will put that link for those of you that are watching this presentation. I'll put that link to that ThinkScript in the description box. Did have a request on that I caught recently. So, all right. Okay, I think we're good there. We still didn't get any results. It's probably just my demo account. All right, well, there we have it. All right, well, let's do this. I'm going to go ahead and take a look at our kind of an overview. I want to take a look at the market forecast and see how we're doing on the market forecast here. See, we're still holding above the 80% or 80 level. It's not really 80%, it's just the 80 level. And it doesn't really matter. One way that some traders will use this is it doesn't really matter the direction of the line. As long as you're above 80, that's showing strength. And one way to say it is that traders will say, hey, the market forecast is giving me permissions to take on long positions. The only difference is what we've discussed here is that maybe, especially after today's pullback, although the market's not closed yet, we might come back down to a prior level of possible support and rally. But yeah, so in other words, there could be a pullback that's occurring right now, and it might continue to dip, but according to the market forecast, we're still showing some strength in here. And one of the reasons why investors might use this, or traders, is that once you are above that 80, you can see that there is a lot of kind of a history of strength that can occur in the market. That's a solid uptrend there, right? Go back and take a look over longer periods of time, and you'll see that a lot of those moves can occur when you are above that 80 level. But I just wanted to reference that real quick. Okay, so let's go into our market and sector review and see how we're doing here. Okay, so we did get a breakdown in the McClellan oscillator right here. Now, we did get above 100 and we dipped below 70. And when you do that, we got below 70 right here. What the McClellan oscillator mentions, Tom McClellan specifically, is that you're looking at a 2 to 3 week either consolidation or pullback. We've been doing this pretty regularly and it has been fairly effective. This was the bounce off the bottom. We did get our 2 to 3 weeks to the upside. And this is off the top, and we'll see if that does unfold. But that doesn't have to happen this way, but that generally is what that indicator is used for. Coming below the 70, look for a 2 to 3 week pullback. Okay, just using the standard defaults here for the McClellan oscillator. Longer term, though, we saw the summation index really showing some strength. We broke above the prior highs, and we had a really solid move to the upside. So this is an extension of maybe the longer term perspective of the McClellan. It is a little bit lagging, but it can mean for larger moves, at least in terms of potential strength. Notice that you were just getting, even though we kept going higher over here, they were just very, very weak highs. And look at that oscillator. It just kept, or the summation index just kept on dipping. So, like I said, it can be quite early, and this is a really positive indication. I mean, according to this indicator, that we're breaking higher here. All right, advanced decline line. I'm going to actually zoom in on that so you can see it. We did take out some previous highs over here, as well as here as well. As you can see, we took out, we exceeded the high. This is a positive for those that are using the AD line for breadth, a breadth indication. We took out the high, but you'll notice we did not take out the high on price. So we had more advancers than decliners make up this move right here, which is compared, related to or connected to this move over here. More strength on the AD line, more advancers than decliners, even above these highs over here. So that is, again, is a real positive. We were wondering last week if we could break into those highs, and we did. So that was, I know, a question that we had, and that's a breadth indication. Now, the key thing with breadth is if you can get enough breadth, what generally is the perspective is if more stocks are rebounding, if there are more companies advancing over time, in other words, more higher highs or higher lows, more trends to the upside, that can help to solidify the trend of the underlying stock itself. So you can get these extended moves to the upside. Perhaps according to the advanced decline line, there's just more strength in the underlying market, meaning that longer term, we could resume higher. We'll have to wait and see. Again, a lot of it's going to be tied to that news flow. Because you could say if things went negative with tariffs, I think this would change very quickly. But you'd want to see like the news flow connect to these higher highs and higher lows in a positive fashion. So more tariffs being signed, things along those lines. All right, let's continue on forward. Have we gotten anything on the SPXEW? What we did get is we got a new high, at least over to this range. Not a new high on an annual basis, but we cleared the prior high. That is a positive because this is really the breadth indication for the S&P 500 specifically. This is clearly right on the S&P 500. We got that. So that ties into these other breadth indication, advanced decline line in the market as well. So that's a positive. I know it's selling off a bit today, but after a pretty good rally, maybe traders are looking for another possibly higher low over here and a continuation. So we have a couple of different breadth indications. Let's go into a weekly chart, a 5-year weekly. And folks, do we have any, with that advanced decline line, do we have any omen spikes? Is what I want to look at here. How are our omen spikes doing? We've had none from here on over. I'm going to try to draw a straight line. Have we had any through here and here? Stopped. And that is the key area, is that recovery to the upside. Will it be a lower low and a lower high? These omen spikes, or the Hindenburg omen specifically, the indicator itself, can help us to give another sort of an indication of that, because we're looking at 52-week new highs and lows, 52 and 52. Okay, I'll put an H up here and an L down here. And if we get a large number of each of these, generally it means a potential fracturing in the market, and it can create a massive chasm, which means that you might have enough force, like we saw right there. Let me show you where this lines up at. Oh, dang. Hang on, let me do that again. I'm just going to go straight up. Right here to right there. You see the recovery bounce? Will it be a lower low and a lower high? If we get these, oftentimes that's what you're going to see, is a lower low and a lower high, because you're just getting that fracturing in the market. 52-week highs and lows, but with so many advancers over decliners, like we had been saying with breadth, if you can get more of that, it can create a consistency of the trend if you get more companies that are showing higher highs and higher lows. And so that's what might be going on behind the scenes, and why we're not getting those 52-week new lows. We're going to take a look at that right now on our next slide, or our next chart, basically here to show you that these are the 52-week new highs that we saw in the NYSE. We're still not, it was a nice bounce off the bottom, but still not a huge bounce. I mean, it wasn't nearly as high as this point, but we didn't make a new high in the NYSE either. So by comparison, we didn't get a new high. So what we'd want to see here, if in fact the NYSE, which is made up of about approximately 2.7 thousand companies, 2,700 plus companies, if we can see it make a higher high and a higher low, we'd want to see this level pop up, preferably to get above that 250, which correlated to higher highs and higher lows in the market. When we were able to spike above 250 here, 250 companies in that group making new highs, that's when we saw a continuation of the chart going higher as well. Yeah, probability traders got so what we're getting at here is to get this trend to go up, traders, investors may have been buying in on the pullbacks. We'll see if that does continue, but there are some interesting signs as to why that could occur. Nothing's 100%, but a few indicators are pointing that direction. Again, though, things can change just like that on a dime, right? Yeah, some of these do, Chris. They do confirm each other. And that's why we use them, back to back, because they're a different read on that indication, as I'm sure you're well aware of, but they're a different read on it. So you get different angles, and then you get different indicators kind of helping us along the way as well. All right, let's continue on. And this is a look at our seasonality. How are we doing? Well, will we see enough? If we can find that base and make higher highs, higher lows off our bottom here, maybe we can begin to mirror the average. I think the trend on the underlying, yearly price this year could make a lot of sense in terms of being able to continue out the rest of the year. That is a seasonal, though, over the past 10 years, and it looks the same virtually on a 5-year, 20-year, very, very similar in terms of what the average S&P 500 looks like during the year. January, folks, through December is what we're looking at. So that's a really cool tool. I'm going to show you where you can find this at too if you haven't used it already. Just go under Style and then Chart Mode Seasonality right here. Standard's the standard chart view. If I click on that, you'll see just a standard chart. But to pull up seasonality, go further back in time. Chart Mode Seasonality. It's just that simple, but it's such good data that we can pull up too. Yes, exactly. Okay. By the way, as noted in the chat, there is a survey, folks. Please take time just to click on that survey if you get a chance. If there's anything you'd like to mention about this class, I think there's only 2 quick questions as well, and there's a comment section. I always read those comments. So too does my manager. And if you get a chance to do that, that'd be fantastic. While we're at it too, if you found value out of today's discussion, if you like these concepts, if you find them helpful, just smash that like button. So easy to do, as well as we'd love to have you subscribe. Subscribe, bottom right-hand corner of the screen. You guys all know where the thumbs up is, but if you are interested in doing that, that would be great. And so there's our survey link as well. All right. Well, everybody, this has been good discussion. Finally, though, here is a look at the 30-minute chart, which is always good to kind of zoom in on a shorter term time frame just to see what some of these prices, the price action looks like, what the chart looks like specifically at these key Fibonacci levels. There is that one off the bottom that we've drawn off the 61.8. Off of the top, that was the break above the 61.8. And here we are just breaking down a little bit. But a lot of times you will see an early indication on a 30-minute chart if, in fact, the market pulls up or pulls down, as we're looking at the S&P right now. All right. Well, hey, it is great to be with you all today, folks. I do love this session. It's always so fun to look at the markets and sectors. And I will look forward to future discussions with you. Thank you very much, Brett, for helping out in the chat. There was a lot of discussion in there. Folks, have a fantastic rest of the day. See you next time.